Hi, it's Darren and welcome to my desk. It's July the 9th today, and just as we're starting to get into the early part of summer and enjoy some beautiful weather, I wanted to take a few minutes and just kind of reconnect and give you an update on what's happening with the practice, what we're seeing in markets, and just talk a little bit about that. The first thing I want to talk about is when you open up your statements in the next few days as you receive them, or if you get them online through our portal system, you're probably going to look at them and ask yourself, is my portfolio stuck in neutral? It feels like we've just been going sideways this year, and that's true. We aren't really seeing the kind of returns we've all come to expect in the last few years. And I wanted to give you an idea of the climate that we're experiencing as investors, which is really important to know kind of what's going on. If markets are going up, down, sideways, we need to be aware of that, so it helps to give us some context when we look at our own portfolios. So I wanted to give you some numbers that I took off of my system this morning, just to give an idea of what's going on out there. So the Toronto stock market, it's only up 1% for this year. A big part of that's because of pot stocks. The Dow Jones in the US, it's actually down 1%. The S&P 500, which is a measurement of the largest 500 companies in the United States, so Apple would be the biggest stock on that list, for example, it's up about 3% this year. And by the way, I'm giving these to you all in US dollars. If we convert them back to Canadian, the numbers move around a little bit. The NASDAQ, which is all the technology companies, that would be like Apple, Facebook, Netflix, Amazon, Google, big companies like that are really all technology related. And that's where all the action's been. And in a minute, I'm going to show you just how narrow it has been. It's actually up 11% for this year. Europe is down. The Euro Stock 50 index is down 1.7%. And then there's a basket of ETFs that we use as a nice benchmark for what our portfolios look like. iShares, which is one of the big ETF providers, they have what's called a balanced growth portfolio, which we use as a really good benchmark for how we should be faring against it. They're actually down 2% for the year so far. The one number that's actually up a lot is volatility. We actually can get measurements of volatility off of the market. And the US market, its symbol is called VIX, V-I-X. As of this morning, it was up 20% for the year. And when I looked at it last week, it was actually up 37% for the year. So it's moving around. So what are we seeing? We're seeing basically across the board, with the sole exception being in a few areas like technology, we're seeing kind of everything kind of being flat, up or down a little bit. So when we look at our portfolios, we can't really expect them to defy gravity. So we should normally see them kind of moving along in a similar vein. Now, and volatility's jumped back up too. So why are we seeing this? Well, the first thing I think is just a statistical reality that we've seen some very good returns, some very good momentum in the last few years. So it makes sense statistically for markets to kind of move sideways for a period of time just to consolidate the gains that they've had. Remember, we don't put the money on an escalator. It doesn't go up perfectly straight. It tends to move in these certain patterns. And one of the patterns that we tend to see for markets is that they tend to have like these surges. They tend to go in a certain direction, then they go sideways for a while, then they tend to surge. Sometimes they surge down, but that's what they do. A couple of positive things we're seeing though. The first one being is that the underlying data, particularly for the United States, is remarkably strong. The data we're seeing around, well, on Friday, for example, we had a really strong jobs report out of the US. So things around jobs, unemployment, employment, corporate profits, corporate margins, the average American household balance sheet, all the data actually is surprisingly strong, really good. So the economic backdrop is excellent, which creates a foundation for more growth in the future. So why aren't we seeing the markets continuing to go up? Well, first, as I said, they do need to take a bit of a pause. So that's a statistical reality that we have to contend with. I think the other one, though, is political risk. We have President Trump who's kind of walking around the schoolyard picking fights with everybody in terms of trade wars. So, whether we get trade wars with China or Canada, whatever they choose to do, his actions are creating more volatility and uncertainty. Now, I think because everyone has come to understand that President Trump is predictably unpredictable, and this is just his negotiation and style, that the market's kind of stepping back and not declining as a result of it. His unexpected behavior is becoming expected now. So I think most people are just leaning back and waiting to see what unfolds. But the tax reform packages that he's put in, and again, the underlying strength of the U.S. economy, I think are very positive. So from our perspective, we're just going to continue to do what we've been doing, which is to stay diversified, stay allocated, and actually look at any weakness we get as an opportunity to add to positions. Now, the other thing I want to talk about is the degree to which, and I've seen this movie before a few times in my career, but we're seeing it again, which is when all the money tends to go into one area. Now, Franklin Templeton gave me a really very interesting piece of information last week, and I wanted to share this with you. And that's the degree to which only a very small number of stocks are driving the market indexes. So the way the indexes are created is that the bigger the company, the more movement, the more influence it has on the averages. So when you watch TV and you hear about the NASDAQ or the Dow Jones, or actually Dow's not a good example, the S&P 500 is a good example, or the TSX, the larger the company is, the more influence it puts onto how that index moves. So for example, in 1999 in Canada, Nortel and JDS Uniphase, two stocks that don't even exist today, they actually became over 30% of the market. So as they moved, so did everything else. So their behavior kind of masked what was really going on. Now in 2017, Franklin Templeton tells me that 6 technology stocks, only 6, accounted for 94% of the total global stock market performance in 2017. That's it. 6 of them, 94%. So Amazon, Netflix, Nvidia, Adobe, Alibaba, and Tencent, and I'll put the chart up, were the real drivers. So if you didn't own those, it was kind of a flat year. And the contribution they have is not only so significant, but the degree to which investors are chasing these securities, whether they're buying the stocks themselves or they're buying ETFs that allocate an overweight to them, is becoming unbelievable to me. So this isn't really a comment on if they're good companies or not. I think Amazon, for example, is a wonderful business, but the price investors are willing to pay is becoming really weird to me. So for example, the price to earnings ratio of Amazon, now what the price to earnings ratio means is that for every $1 of earnings, it tells me how many years of those earnings it takes to buy one share of the company, right? So if a company has a PE of 10, and it earns $1 a year, it means it's going to take 10 years for me to have enough dollars to buy the security. So it gives us a valuation metric. Now, Amazon's PE is over 140 now. 140. That means at its current rate of earnings, it takes 140 years to buy one share of the stock. Now, if you're thinking at home that sounds expensive, it is expensive. The average, if I look at the average of the PEs of all the stocks in the market, the number becomes something like 18 to 20. So the average is 18 to 20, and it's at 140. So that's expensive. Now, it may be worth it if they continue to deliver, because that's what investors are betting on. But I don't even know if they're actually paying attention to the math. So what's also amazing is that Amazon could actually drop by 50%. Its stock price could drop by half, and it would still have a PE of about 70. It would still be very expensive. So again, Amazon, wonderful business. We own it in one of the models I run, but very small amounts now because the profit margin the profit on the stock has been crazy. Buying it today is a really interesting bet on the future. So again, we've seen such a huge amount of money go into such a small number of companies. It's kind of masking the fact that most portfolios are flat, not going straight up. And this brings about an interesting piece of wisdom from Warren Buffett. So years ago, he made an interesting comment. He said, in the short term, the market is a voting machine, and it votes for what's popular. In the long term, though, it's a weighing machine, and it weighs value, and it weighs quality. So what do we take from this? Well, the first thing is we don't go chasing what's popular because it's too expensive, right? We have to look for value. So whether it's pot stocks in Canada, the Bitcoin, those digital currencies, or really expensive technology stocks, we're going to take profits. We're not going to allocate there. And we're going to use this opportunity to make sure our portfolios stay balanced and stay diversified and look to add to more quality as we can. And that leads me to what we've been very busy doing. I learned, by the way, when I first got married, don't vacuum if my wife's not home, because if Sue didn't see me do it, it didn't happen. So sometimes I'm not good enough, I think, about explaining to you all the work that we do on your behalf. So we do a huge amount of due diligence, not just into the investments that we have, and we have to always go back and double check and refresh that due diligence, but we're always on the lookout for new and great ideas. And I may have told you in the past, you know, we have to kiss a lot of frogs to find one prince. That's maybe not the best analogy, but it's the best one I have. So we need to find great investments for you, which means, and I do all my own homework. So yes, we listen to analysts. Yes, we talk to the research people. At the same time, we go and do our own homework. And Pedro and Nick have now been very good at being involved in that process with me, so I can not only teach them, but I can also get their perspective and advice also. So I've been working hard on a number of ideas for you, particularly actually in the fixed income space, in the bond space, because we've now seen bonds go through a 40-year bull market that's ended. So we're now, all investors are confronted with what do we do with what used to be the safe part of my portfolio is now increasingly going to become the riskiest part of my portfolio. And it's going to be risky because it's just a math problem. When interest rates go up, traditional bonds go down. What do we do? And especially as we approach retirement and go into retirement when we're supposed to be turning the dial, traditionally from less stocks, more bonds. Well, that could become actually one of the worst things to do. So we've been spending a lot of time trying to figure out the answer to that conundrum, and I think we found a few good ideas, some of which we've implemented, and we have more you're going to see come in as we go into the fall. Okay, so that's enough about markets and performance and that kind of stuff. Let me get into some other fun things. So you're probably wondering if Andrea's had the babies yet. The answer is no, not yet. We're still waiting. She and Mike have twins due literally any day now, so we're all waiting and praying and hoping that the delivery is easy and quick and fast and safe and healthy for everybody. So as soon as we know more, we'll make sure that you know. We've been without Nick for the last 3 weeks. Nick's taken all of his vacation at once this year, and he's done a wonderful tour of Europe, taking advantage of those 25-euro flights to hopscotch around. So I've been following on Facebook, and I'm highly jealous. I think he's having a wonderful time, and he deserves it. He's worked really, really hard, so I'm glad he's taking advantage of the time he's got and making the most of it. So good for him, and we can't wait for him to come back on Monday because there's about this much work on his desk. While he's been gone, Vicky and Pedro have been doing an amazing job keeping all the trains running on time. So both of them will take a bit of time off in August and kind of recharge the batteries. And I'm so grateful that they're here to look after things. We also have been busy with a number of other items. I have teenagers, so no one listens to me at home, so it's been nice for me to be invited on a few panels recently. So I was on a panel for the Canadian Alternative Assets and Strategies Association, which is basically all the top hedge fund and alternative and highly active investment managers belong to that. And they had a conference in Toronto recently. And they had asset managers from around the world attend, and they asked me to be on a panel called What Investors Want. So I was able to give our feedback, my feedback to that community for the kind of investments that we're looking for that would be of interest to us. And it's nice to be able to help shape the industry a little bit and have a voice to say, as on behalf of our investors, these are the kinds of things that we'd be looking for and be interested in. Advisor.ca had a conference. They had their 20th anniversary this year. That, by the way, is a magazine and a website that's really the premier news source for advisors in Canada. I've been on their editorial advisory board for over a decade. So when they had the conference, they asked me to sit in a panel called Be a Better Advisor. I'm actually going to give you the link to the article that they wrote after the conference so you can hear some of the things that I shared with advisors from across Canada. What else have we got going on? Oh, this thing. What is this? This is a bed kit. As many of you know, Sue and I next week are going to be leaving for Tanzania. And we've raised, as a group, there's about 9 of us from Raymond James that are going, and we're going to go to Tanzania, and we're going to spend a week giving out these things, which are bed kits. So in here, there's a mattress, there's mosquito net, there's some, what else is in here? There's some school supplies, there's some, these are like Crocs. There's all kinds of things, mosquito nets, there's all kinds of things for children that really don't have anything. And so we are blessed to be part of legacy with Sleeping Children around the world. They've given out over 1.5 million of these things to kids in over 34 countries since 1970. So it's a wonderful thing to be part of. I'm actually surprised as I've talked to people how many people know of this charity. And so we will be eyeball to eyeball with every kid that gets one. So over 3,000 of these we're going to give out. And thank you, by the way, because many clients have been very generous in donating to buy 1 to 50 bed kits. Sue and I, on our own, bought 114 of these to give out. So so the blessing for us will be to actually be there and see every child as they get one. So that's the first part of our trip, and we're really looking forward to that. And then we'll spend the next 2 weeks seeing animals and hopefully not getting bitten by anything. We've had all of our shots and so forth. So that's what Sue and I will be doing. And assuming I don't get eaten by a cheetah, we'll be back. So there you go. So that's our quick update. I want to thank you very much for your trust and for your confidence, and let you know that we're still here, we're still vacuuming, doing all the stuff that we can do. And if you need anything, just send us a note, give us a call. Someone will be here, because we always are. And we'll have more updates coming for you as we get closer to the fall. So I will see you in September. Have a wonderful summer, and thank you very much.